A silver price crash can feel like the market is screaming at you to act, especially when you see a big red candle and a round number like $90 on your screen. But here's the uncomfortable question most people don't ask. If the price is truly that low, why do buying quotes sometimes vanish, delivery times stretch, or dealer sites suddenly slow down? Today I'll explain how a silver price crash can happen in the paper market, while the physical market behaves very differently, and what that gap may mean. By the end, you'll have 3 takeaways. A. How price discovery works when futures dominate headlines. B. What delivery windows can change in trader behavior. And C. How to read premiums and availability without panic. And there's one detail most people miss during sell-offs: the all-in spread between paper price and real-world purchase cost, and I'll show you how to track it later. First, quick context: precious metals trade globally, across futures exchanges, wholesale spot markets, and retail dealer networks, and they don't always update smoothly at the same time. When volatility spikes near contract roll periods, month-end positioning, or macro news, rates, inflation expectations, dollar moves, pricing can lurch. Also, a quick note: I'm not telling you what to buy or sell, and I don't know your situation. This is educational market structure analysis to help you think clearly when headlines get loud. Now, if you're a beginner, the key mindset shift is this: the chart is a summary of the last trade in a specific venue, not a guarantee that you can transact size instantly at that price in the form you want. That doesn't mean anything is rigged by default. It means markets have plumbing: liquidity, inventory, hedging, settlement, and that plumbing shows stress when everyone rushes through the same door. So, let's define the problem in plain English. When people say silver is down, they usually mean a quoted benchmark, often a futures-derived price or a wholesale spot reference tied closely to futures. That benchmark matters because it influences hedging, inventory valuation, and many dealer price sheets. But in real life, you don't buy benchmark silver. You buy a specific product: a 1-ounce coin, a 100-ounce bar, a round, or sometimes older circulated coinage that needs refining. Each product has its own supply chain, fabrication capacity, and buy-sell spread. Think of it like seeing a low airfare advertised. It's real. But by the time you add baggage fees, seat selection, and limited availability, your all-in cost might be very different. In metals, that difference shows up as premiums, delayed shipping, reduced buy limits, or wide bid-ask spreads, especially during a sharp silver price crash when dealers and wholesalers are trying to keep up with fast-moving hedges. Now we need to separate paper from physical without turning it into a conspiracy story. Paper silver, like futures contracts, exists mainly to transfer price risk. A refiner, miner, manufacturer, or dealer can use futures to hedge inventory. Traders use them for exposure. The benefit is speed and liquidity, but the trade-off is that futures pricing can move quickly on positioning, margins, and liquidity conditions, even if physical supply and demand shifts more slowly. Physical silver is constrained by mining supply, recycling flow, fabrication capacity, minting and bar production, and the willingness of holders to sell inventory into the market. These two worlds are connected, especially through hedging, but they are not identical. During stress, the link can stretch. That's why you can see a dramatic move on screen and, at the same time, hear that certain products are hard to source or that premiums are sticky. This is not a promise that price will rebound. It's simply an explanation of why the message from the chart may not match the experience of trying to transact. Next, the futures calendar. Futures markets have rhythms, contracts expire, traders roll positions, and some participants can stand for delivery instead of closing out. When a big contract month approaches key settlement dates, behavior changes. Some traders reduce risk, some roll, some increase hedges. Liquidity can shift from one contract month to the next, and that alone can create sharp intraday moves if many players try to exit or hedge at once. Here's the mechanism. If volatility rises, exchanges may raise margin requirements that can force leveraged traders to reduce positions, which can accelerate moves. The impact is that price can drop fast even if physical buyers are still interested, because the forced activity is happening in paper positioning. This is also why you'll often see strange price action around month-end. Funds and institutions may rebalance, dealers may adjust hedge books, and risk managers may demand smaller exposures going into reporting periods. Again, none of this guarantees a direction, it just explains how a sudden air pocket can form. What about delivery data, like delivery notices in gold or silver futures? It can be useful, but it's easy to misuse. Elevated delivery activity can mean some participants prefer to convert paper exposure into metal, or that certain shorts are comfortable delivering inventory, or simply that the contract month has unusual participation. It does not automatically prove a shortage, and it doesn't automatically predict price direction next week. The clean way to use it is as one input about stress and preferences. Cause if more participants want metal or prefer settlement through delivery mechanisms, delivery figures can rise. Mechanism: the exchange's delivery process matches longs who stand with shorts who issue deliveries, often through warehouse stocks and eligible registered categories. Impact: if delivery interest stays high while inventories fall or premiums rise, that combination may tell you more than any single statistic. So if you hear commentary about gold futures delivery spiking while prices are sliding, treat it like a check engine light. It tells you to look deeper, not to slam the gas or the brakes. Now let's address dealer outages and maintenance messages during chaotic sessions, because that's where people feel the mismatch most directly. Retail dealers are not exchanges. They're businesses managing inventory, payment risk, fraud risk, and hedging. In fast markets, a dealer may have trouble updating prices accurately or may hit limits with wholesalers, payment processors, or risk controls. If a dealer sells a large amount at the new lower price, they typically hedge price risk, often using futures. But if liquidity is thin, bid-ask spreads widen, or systems are overloaded, hedging becomes harder and riskier. The rational response for a dealer is to widen spreads, reduce maximum order sizes, pause certain products, or temporarily slow quoting until they can reprice safely. That can look like a lockout to the customer, but from an operations viewpoint, it's often about not promising a price they can't offset. The key point for you is practical. During a sharp drop, don't assume the screen price equals an executable retail price, and don't assume a paused website means something must happen next. It usually means the pipes are strained. Here's the detail most people miss in a silver price crash. The only price that matters for your decision is the all-in transaction price and liquidity for the product you actually hold or want. If spot drops 20% but retail premiums double, your effective discount may be far smaller. And if you're selling, the bid you receive can fall even more than spot if the buyer widens their spread to protect themselves. This is where you should compare 1. Paper benchmark move, 2. Retail premium changes, and 3. Delivery availability signals. Example: imagine spot falls from 100 to 80, a 20% drop. If a coin premium rises from 5 to 15% because supply is tight, your buy price goes from 105 to 95, only about a 9.5% drop. That doesn't mean buying is bad or good, it means the sale you think you see might not be the sale you can actually access. This is also why two people can argue about whether silver is cheap, and both can be correct. One is talking about paper, the other is talking about real-world acquisition cost. Let's add ETFs and shorting signals without overcomplicating it. Vehicles like SLV can be useful for exposure, but they trade like financial assets. They can be influenced by broader risk-off moves, liquidity needs, and hedging flows. Some investors watch borrowing costs, the fee to borrow shares, and share availability to short as a sentiment gauge. When borrow fees are high and shares are scarce, it can suggest heavy short demand. When borrow fees are low and shares are plentiful, it can suggest the sell-off may not be driven by crowded shorts. These are not magic indicators, and they can change quickly. The right way to treat them is as context. If the silver price crash is happening alongside stable borrow costs and wide physical premiums, that can hint the stress is more about fast paper flows than a sudden collapse in physical interest. But be careful, ETF dynamics do not automatically translate into immediate physical shortages or immediate rebounds. They're different layers of the same ecosystem. Now, risks and common mistakes, because sharp drops are where portfolios get damaged. First, risk, leverage, and margin. If you're trading futures or options, a fast move can trigger forced liquidation, even if your long-term thesis is intact. Second, liquidity risk. In stress, spreads widen and you may not get filled where you expect. Third, counterparty and settlement risk. When systems are overloaded, cancellations, delays, or repricing policies matter. Fourth, timing risk. A market can stay volatile longer than you expect, and a cheap price can always get cheaper. Fifth, narrative risk. Believing a single story like it's all manipulation or it's the end of silver can push you into emotional decisions. If you want one simple analogy, use this. Futures pricing is like a thermostat reading. It can change instantly. Physical supply is like the room temperature. It changes more slowly. When the thermostat swings wildly, don't assume the room instantly followed. So what do you do with all this? Here's a simple, repeatable 5-step framework for days like this. Use it to slow your decision-making down. Step 1. Identify which price you're looking at: front-month futures, spot reference, ETF, or retail product. Step 2. Check liquidity conditions, spreads, volatility, and whether the market is around a roll settlement window. Step 3. Compare physical signals, premiums, shipping times, product availability across at least 2 dealers, not just one. Step 4. Look for cross-market consistency, gold versus silver moves, dollar strength, real yields, and broad risk sentiment. Step 5. Decide on risk first, not prediction. Ask, what position size and product type can I hold through volatility, rather than how do I maximize this move. This doesn't tell you the future, but it reduces the odds you act on a misleading snapshot. What to track over the next days if you want to understand whether the silver price crash is stabilizing or spreading. Watch 1. Futures curve behavior. Does the next active month trade differently than the expiring one? 2. Physical silver premiums for common products. 3. Dealer inventory status and shipping estimates. 4. ETF discount, premium behavior and volume. 5. The dollar and real rate expectations. And 6. Any sustained change in industrial demand narrative. And here are 3 actionable non-advice steps you can take. First, write down your objective, trading volatility versus long-term hedge, before you place any order. Second, reduce complexity. Avoid mixing high leverage with illiquid products when spreads are wide. Third, keep records of your all-in prices, spot plus premium plus fees, so you don't anchor to a headline quote that you never actually traded. Let's recap in a few lines. A silver price crash on a chart is not the same thing as easy, instant access to cheap physical metal. Futures can move fast due to positioning, margin, and calendar effects. Delivery data can be informative, but must be combined with inventory and premium signals. Dealer outages or frozen quotes often reflect risk controls and hedging constraints, not a guaranteed next move. If you stay focused on all-in costs, liquidity, and risk sizing, you're less likely to make a permanent decision based on a temporary market dislocation. If this breakdown helped, like and subscribe, because I'll keep translating market plumbing into plain English. Question for you. When volatility spikes, do you prefer to track physical premiums, futures structure, or ETF flows, and why? Remember, markets are risky and volatile, especially with leverage and thin liquidity. This is educational, not financial advice.